Hey, I'm Mike Milan with Elevate Financial Training, and I tell you, we've got a great program put together for you today, and we're going to talk about getting cash, growing cash, and keeping cash. But first, let me just tell you just a little bit about our member community, and here's what I mean by that. It's free. It doesn't cost you anything, but occasionally I develop tools, I develop spreadsheets, worksheets, other things like that that help you work with your clients, help you work with your small business owners, but it helps you. In the member community, there's a file sharing ability, which means I can put files in there and you can use them for free. Here's a secret. If you don't join the member community, I also sell those worksheets and templates and videos and things like that as well. So if you'd rather pay me, that's fine. If you'd rather pay me and just get those things for free, just become a member. Now, of course, you're joining my emailing list, and I'm going to send you an email every once in a while, but you never know. I may be coming across great things that, you can use. With that in mind, here's some things you're going to get. The free resources I talked about. You're going to have an exclusive members-only invitation to our app. Yep, I have a mobile app that we can communicate, that you can use the files with, that we can talk about. Really, it's just a way for us. It's a private social network for people like us that believe the same way about cash flow and want to help our clients. You got discounts on paid materials just because you're a member. And of course, I'm going to have some member-only training events, which means webinars that I won't even put out to the public, just for you. So that's what becoming a member of, the Elevate Financial Trainings community is all about. My hope is that it becomes robust. It becomes a source of sharing for both me and for you. We'll both learn and we'll help small business owners together. So the website for that is elevatefinancialtraining.com and then /members. If you forget about that, it's just at the top of the toolbar, right at the menu bar. Click members. You just sign up. All you have to do is give an email address and you're in. Boom, free stuff. Okay, well, let's get to the real reason why you're here. Right? You're here because you want to know how to get cash, how to, grow cash, and then how to keep cash. This is important, this one particularly, because I hear a lot of people talking about growing cash, forecasting cash, looking at what my cash balance is going to be like in the future. All of them focus on, guess what? The profit and loss statement, the income statement. Nobody talks about the balance sheet. So I'm going to show you today is a cool little trick, a unique trick to actually forecast the balance sheet. And when you forecast the balance sheet, it tells you if you have enough money to grow, right? Are you actually going to have enough money to do what you think you're going to do? And then I'm going to end with another neat trick called the financial impact map. And what the financial impact map does, it tells you exactly where hidden cash is in your company. So I'll show you how to do the calculations, how to find that hidden cash, because, hey, you can't keep it in your company if it's leaking out the backside. So I'm going to show you where it leaks and how to keep it from leaking. So thanks for joining me. Let's get, grow, and keep cash in our company. First of all, I've got to tell you that profit and cash are not the same. Of course you know that, right? Profit is paper. It just exists. And profit, especially if you use, there's two different types of accounting. One is the cash-based accounting. The other is the accrual-based accounting. Accrual, I say cruel like they're mean. It's cruel. It's cruel because it tricks you. It tricks you into thinking that, maybe you have money and you don't, because having profit on the income statement is great. It shows you have a viable business. It shows you that you sold more than you spent that month, but it doesn't mean you have cash in the bank. Too many times business owners look at themselves at the end of the month and go, oh, I made money, but where'd it go? Where'd my money end up at? So that's what I want to talk about, is that difference between profit and cash. And the reason it's so important to me is that 50,000 business owners file bankruptcy per year. 50,000. 35% of those are said to have net profit on the books. That's right. They think they're making money and they really don't. So what I try to do is focus on the cash. Cash is what you can spend. Cash is what you can, keep in the company, reinvest in the company. Profit's great, but I'll take a company with cash over a company that has a lot of profit any single day. So let me show you how to get it. All right. Before I get to that, there's only 4 ways to make money, right? I don't care how you describe them to me. I'm going to say that you can look at just 4 things in your company. There's only 4 ways to make more money, and that's it. So you can describe them any way you want to, but there's only 4, and here they are. First things is you can increase sales, right? Now, Mike, you're going, this is way too simple. Of course we know that. Yeah, just bear with me. Cut the guy some break, a little bit of slack. Yeah, you can increase sales. That's probably the hardest one. That's why I say that one's first, right? The second thing you can do is cut expenses. Now, everybody goes here first, right? This is where everybody ends up at. I'm just going to cut expenses and I'll have more profit at the end of the month. True. That is true. Now, there's a warning here that don't cut the expenses that actually drive your revenue. There was a point in time when I actually ran a restaurant. I had a competitor that actually went out of business because they cut expenses, but they cut the wrong ones. They cut marketing. They cut advertising. Guess what? When you stop telling people to come to your business, yeah, they're going to stop coming. That's exactly what happened to him. Where we cut, during the 2008, 2009 downturn, we cut labor, right? Because that's one of the largest expenses I had, was that labor. We actually looked for cheaper ways to buy our product, make the product, but we kept the advertising in place. Why? Because I still wanted people to come. Matter of fact, it's more important during an economic downturn because people have to be kind of, enticed, given a reason to come back into your business. When you cut expenses, don't cut the things that actually drive your revenue, because when you have less revenue, you're going to have less profit. It doesn't matter how many expenses you cut. Number 3, the third way that you can make more money is you can increase your price. Yeah. Some people try to say, well, if I increase my price, that also increases my sales. True, but not all the time. You can actually increase your price without increasing sales. Yeah. I mean, people just buy less, right? They buy less, of that particular unit. And that's okay. Now, I tell you, when I lived in Seattle and I did that for 8 years, there's a company based in Seattle that is the absolute best in the world at increasing price. They are, and I saw it. I mean, we had a Starbucks right across the street from our office, and I went over there one day, and I said, you know what? I'll have a grande caramel macchiato. And the barista behind the counter says, yes, sir, that'd be $4.47. No problem. 3 months later, I go into Starbucks, and I say, you know what I'd like this time? A grande caramel macchiato. Right? So he says, sir, that'll be $4.58. I'm like, wait a second, it was $4.47, now it's $4.58. And what I realized is that every 2, 3, 4 months, Starbucks puts anywhere from 5 to 15 cents on every product and keeps raising the price until demand comes down. They are the best in the world. If you remember this from school, the best in the world at practicing the price elasticity of demand. That's right. They are raising prices until demand starts to drop off, and then they kind of hold the prices in place. So increasing price is a way to make more money. And if you can get away with the same thing Starbucks does, why not, right? I mean, first of all, who knows how much something costs in Starbucks? So that's always funny to me to say that. So here's the last one, number 4. Number 4 is, of course you can buy better, right? Which means you can actually kind of work with your vendors, buy your goods, buy your services. If you can get cheaper labor or find more efficient ways to do what you're trying to do, you can buy better, which is actually decreasing your cost of goods sold, which increases gross profit. And I'll tell you a little secret about gross profit. Once you have your expenses covered, the net profit line will increase by the gross profit percentage. I harp on gross profit all the time. It's the only place you can get cash in the company is gross profit. So you got to manage it religiously. Gross profit, gross profit, gross profit. So those are the 4. You can increase sales, increase price, you can cut expenses, or buy your goods or services just a little bit better. I don't care how you describe it, that's the only way to make money in your operations, those 4 things. Now that I said that, let me show you some other things that you can do. The first thing, I'm going to break them down. We're going to start with getting money. How do we get money in our company? Then we're going to go to actually growing money in our company, forecasting it, and then also keeping money, or what are some things we can do to keep money from leaking out the back door. So we'll start right off with getting money, right? We're going to get money and put it into our business. There's a whole host of ways, right? I mean, what's the best way a startup gets money? It's the 3 F's, right? It's friends, it's family, it's fools, right? So, and they're not fools because, they're just dumb about the way they invest. They believe in the guy, more so than the idea or the product. They believe in the guy. They think he can do something, so they'll invest into it. But it's just a funny way to say, that startup people have to put in their own money. They got to put their own skin in the game. I don't care if it's time. I don't care if it's, a second, mortgage on your house, your credit cards, your savings. You have to put your own money in. But besides that, there's some other ways to get cash into your company. All right. And we're going to talk about that. But before you understand how to get cash into your company, you got to figure out what you're offering, right? Before you go to an investor, before you go to the bank, before you go to anybody else in the world and ask them to buy your product or your good, you got to figure out what is your value proposition, right? What are you really offering? Because, price will always be too high if you have no value. And that's what I always say. Your price is going to be too high no matter what you do if you have no value. So you actually have to have that value proposition. What that means is that the perceived cost subtracted by the perceived benefit has to be greater, right? So the benefit that you get has to be greater than the cost, that you incur. I mean, that's why some people can charge $8 for a hamburger, and other restaurants can actually charge $19 for a hamburger because all of the things around it, the lights, the mooding, the music, the mood that they create, the guy with the towel over his arm, all of those things create the mood, and you're willing to pay a little bit more for that hamburger in that place because, well, you feel like you're getting the benefit. You feel fancier, right? So you pay a little bit more money. But it's still a hamburger. It's still just, ground beef, a bun and some garden stuff. That's all I've got. So, but your value proposition is that important, and you have to start there. Why should somebody buy from you, and why is the price right for it? If you follow me in the past, you know that I've got an exercise I go through that says, price doesn't matter. So look for that in a future, lesson, but why price doesn't matter. So here's what it really does matter though, is people have to understand, who you are and what is your value proposition. And to that end, you have to start with the end in mind. Where are you going, right? Your ultimate goal in your business is to build transferable value. And transferable value is really just, do you have enough money to do whatever it is you want to do next? Whether you want to retire, buy another larger company, push things down to your children. It doesn't matter what you want to do. Maybe walk away and just close shop. Do you have enough money to do whatever it is you want to do next? To get there, you've got to start with the end in mind. That's why when you're getting cash, when you're getting set up, I want you to think about running your business as if you intend to sell it. Right? What's it look like in the future, right? Because when you put your car on the market or you put your house on the market, you clean it up. You make it presentable. Your business should be that way too, because people tend to invest more. They'll buy more from you. They'll come more often. They'll pay more for your business in the long run if you start with the end in mind. What's this look like? And it should be, like it's on the market even today, even if you have no intent to sell. So start with the end in mind. Know your transferable value number. Getting money in your company. First of all, there's 4 different ways you can get money in the company, right? And one of those is, you can get cash from operations, right? And we talk about 4 ways to make more money from your operations, but that's really, do you have something to sell? Is it a good? Is it a service? Is it priced right? Do you control your own cost? Do you practice good expense control on your own? And then at the end of the day, you have more cash. So that's number 1. I won't spend a lot of time there. Everybody knows, hey, I run a business. At the end of the day, I should have profit. Profit should be cash. All right. Number 2 is, hey, you can sell your assets, right? I'm not lying. That's another way to get cash in your company. If you're in a cash, poor position right now, or you're in trouble, you can sell your assets. That is a huge red flag, though, to everybody around you. If you start selling your assets, first of all, the only reason to buy an asset is to increase revenue or increase profit. That's the only reason to even buy it. That's the only reason to even get it, right? Is if it's going to make you more money or make you more profit. Other than that, you shouldn't be buying assets. But you may be in a position where you have assets already. You have things that are either outdated, or they are obsolete, or they don't fit your need anymore. Maybe they're undersized, under capacity, and you're upgrading. It's okay to sell those assets if they're not being utilized, right? So those assets you don't use, sell them, bring more cash in. Actually have the assets on hand that generate revenue and profit. Think about that. Does it generate revenue? Does it generate profit? Accountants all the time, not bagging on you, but sometimes you ask people to buy farming equipment, but they can't generate more revenue off of it, but it does reduce their tax exposure. So what I'm saying is, ask first, does it generate revenue and does it generate profit? So those are the 2 kind of ways inside your operation. Let me talk about the 2 big ones now. The 2 big ones is, I can use debt financing, right? I can use debt financing, which is, I go to the bank, I get a loan, and I pay it back, right? Maybe I get a $50,000 loan at 7%. What do I owe the bank at the end of the term? Well, just 7% of $50,000. That's it, right? but you're actually, you actually have to make that note. So that's debt financing. The other one is take on investors, take on partners, take on, VC money, angels, somebody like that. That's the other way. So you got debt financing and equity financing. The difference between the two, why would a VC firm, an angel investor maybe get 20% of your company, as opposed to the bank who only gets 7% of the loan that they make you, right? Well, that's the risk tolerance of both. A VC firm will have a little bit higher risk tolerance, but they're going to spread it across 10 or 15 different companies, and they need one to hit, right? Because if two companies, one takes on debt, one takes on equity, the one that takes on debt goes from 0 to $1 billion valuation. The bank only gets 7% of the original loan, that $50,000. But a VC firm, if a startup goes from 0 to $1 billion and they have 20%, that's a huge number, right? That's a big thing. They only need one of their 15 in the portfolio to hit like that, and they've got a pretty good return on their investment. So the risk tolerance is a little bit different. It spreads across, but the rewards are so much higher, right? VC is higher risk, higher reward. Bank, lower risk, lower reward. But it's necessary for both. You have to figure out which one's right for you. Is debt financing right, or is equity financing right? So let's kind of take a look at the pros and cons of both, or kind of the differences between those. And then another lesson, I actually talk about how to prepare for a bank loan, where I've got some worksheets that tells you about the likelihood of being able to get a loan. Or guess what? You can just use our 30-minute introductory free conversation and talk to me about it. And, I can kind of give you some advice. But debt financing, I'll go down through kind of a list. First of all, here's the things that are true about you. I don't want to invest a lot of time. If you go after investors' money, it takes a lot of time. You got to convince a pool of people or a company to invest in you. So it takes a lot of time, and you don't have a lot of time to do this. Secondly, I can make loan payments from my profit. Term loan payments are made with retained earnings or net profit. So you got to think about that. Do I actually make enough in profit? I can make this loan payment. That's kind of the trigger that banks are going to look at. Do I make enough money in profit to make the loan payment? Then the amount I need is small enough. It's a smaller one, and it funds organic growth, right? It's small enough. I don't have a big idea that's going to go nationwide. I don't have something that's going to go worldwide. We're going to be the next Facebook, but it's small enough. Organic growth. You're probably right for some debt financing at that point in time. And then I don't want to give up control of the company. It's a big one, right? Giving up control of the company is huge because, some people don't like to do that. They don't like to have to answer to a board. They don't want to answer to other investors. They want to be in control of their own destiny. So if you're the type of person that doesn't like to give up control, then debt financing might be for you as well. And then lastly, I have good credit, right? I think everybody knows this. If you're going to go to the bank, chances are you're going to have to do a personal guarantee. If you have bad credit, there are other ways to get money, but, at the same time, if you have good credit and you actively participate in managing your good credit, this is the way to go. So let's contrast that with actually getting some investment money. First of all, I can take my time and look for the right partners, and that's true. What's the partner? Because it's almost like you're getting married, right? You're getting married because you're going to have to work with your investors in order to make more money with them in the future, or to encourage their further investment. So you want them to trust you. You want them to be in love with your company. Again, it's almost like being married. And you have an idea or a company that can become a national brand, right? That you've got to think that way. They're not looking for the small, I can take over the neighborhood. We're looking for that company that's going to be a household name, right? You've got to think Facebook. You've got to think, who knows? You've got to think one of the Uber, right? Uber, Lyft. You've got to have something that can and has the likelihood of becoming a brand so big that everybody knows about it. And then you need a lot more money to grow, right? You're going to need substantially more than what a loan can undertake. We're not talking about a $50,000 loan. We're talking about a $5 million investment, right? Substantially more money. So if you're looking for larger funds and you have, that idea or that company that can become a national brand, you're looking at the right way to become, looking for investors. And then, you need some guidance, some wisdom. You want introduced to somebody else. Those relationships. When I say pick partners and you become married, the relationships of your partners or investors, they become or can become your relationships as well. So you want to look at that as, what does my investor group bring to the table? Who do they know? Who can they introduce me to? And have they done this before? If they've never been in your line of work before, chances are they haven't encountered some of the things that you might encounter. You want to look for people that understand your industry or what you're trying to do best they can, right? Best they can. And then last ones, I'm not worried about sharing control or profits with others for the success, right? Because even if you're diluted, you're not at 100% ownership, you're at 50%, well, you could be 100% of zero because you failed, or you could be 50% of a million. So it depends on how you look at it, right? So if you're not afraid of giving up control and you need the other things, more money, more coaching, more advice, more wisdom, and you've got time to look for that right partner, then equity financing might be something you want to pursue. So those are kind of the difference between debt financing and equity financing. And we're talking about getting money into the company. How do I get that jet fuel to get going? Again, those are the couple ways you can do that. So let's talk about growing cash. Now, I promised you right up front, I'm going to blow your mind with this technique, right? Because yay, I've got a company, or I'm already up and running, but now I want to grow. Now I need to know what it's going to look like. And you can use a lot of products out there that can forecast your cash. Do I have enough money to pay my bills next month? Well, what it doesn't tell you is how much you're going to be short, because they stop short of looking at the balance sheet, right? And remember, the profit and loss statement is just, it's just going to tell you if you had a good or bad month, quarter, or year. It's not going to tell you if you have a good or bad company and does it work right and does it have enough money and how money moves through the company. That's what the balance sheet does. It's the combination or culmination of every single decision you've made as a manager or otherwise. So you got to look at that balance sheet. So I'm going to teach you a quick way to forecast the balance sheet based on what you think you can grow. And what I'm going to use is a technique called common sizing. That means no matter what the sales level are, I try to keep my percentages of the accounts at the same level as they are at my current sales value. So in this sample company, we currently have about 800,000 in sales, right? We currently have about 800,000 in sales. Now, when you become a member or you're watching this course online, there's resource material that you can download in addition to, watching this video. So if you're looking at the resource material, you'll have a blank worksheet of this, and you'll see the numbers that I'm using when I populate, the actual worksheet here. So sample company has currently 800,000 in sales and earns 5% net profit after tax. And what we're looking at is actually, the balance sheet. Now, if you notice, this is side by side. It's not assets on top, liabilities, and equity on the bottom. It's side by side because the technique that I use actually works better if I line out the balance sheet like this. So remember I said I'm going to blow your mind. I'm going to give you a different way to look at it. And what I'm looking at is assets are on the left side. We got cash at 16,000. If you notice, I got percent of sales. That's saying that on average, my cash tends to hover around 2% of my sales. My accounts receivable are about 25% of my sales. My inventory is about 28% of my sales. Do you see what I'm talking about there? So my current assets take up about 55% of my sales value, right? That's kind of how my balance sheet works. And if you go back and look at your balance sheet, you're going to see that it tends to be pretty consistent with your sales value over time. There tends to be a trend that occurs. You notice I don't do the same thing, though, with equipment or leasehold improvements or things like that, because they don't tend to move as frequently as, our sales and our current assets do. The same thing happens on the other side, on current liabilities. You've got accounts payable at 17% and accruals at 5%. And this person actually has no notes payable, no line of credit, so he doesn't have any current liabilities or credit cards that are out there at this point in time. But he's got long-term debt. We didn't mess with that because, again, we have to make a management decision to take on or buy more debt or take on long-term debt or buy more equipment. But the other ones tend to move in our sales capacity, our sales value. And then, of course, our equity. Now, our equity, that line gets changed by our retained earnings, right, or investments that we make. But net profit at the end of the period gets put on the balance sheet in the form of retained earnings or equity. So you got to remember that, because that's important for doing this forecasting technique, is how does the equity change, right? Now, here's the scenario, right? The scenario of a company I worked with, he wanted to forecast his growth, right? So we looked at his balance sheet and it looked like this. Now, in this view, I've dropped off all the fixed assets and all the long-term debt and equity. I want you to focus on the left side of assets, and current liabilities. That's what I call variable assets because they vary with sales, and variable liabilities, again, because they're more variable with the sales. They tend to move along with sales. So that's variable assets, variable sales. Very important for the common sizing technique because that's, and then later on, in another lesson, I'm going to teach you a sustainable growth formula. So you're not guessing saying, how much should I grow? I'll give you the formula on how much you can grow based on your variable assets and your variable liabilities. So let's forecast his growth, all right? In the blue box in the top left corner, that's the old one. That's the current one. That's the one we just looked at. At $800,000, he has about $916,000 in assets, and of course liabilities and equity. So that's at the current value, right? Which is $800,000. But he doesn't want to be there. You know, when I talk to him, he actually says, I want to increase sales this next year from $800,000 to $1.4 million. You're like, yeah, okay, that seems reasonable. You know, yeah, if he's already doing $800,000, he could probably do $1.4 million. But I got to tell you, that's a 75% increase, right? So you got to think about it that way. You're like, oh, wait a second, you're almost going to double your company. Do you have enough money to do that? You know, is there enough cash that's actually coming through your company that you can actually grow that much, right? It's a guy that just goes, hey, I'm going to try to grow, and he just kind of guesses at how much he can grow. Well, what you can do as an advisor is help him see whether or not he has enough money to be able to do that. Right? It's one thing to say you can do it and be able to do it. He might be a great salesman and be able to increase sales that much, but does the cash flow through his company in a manner he can support it? Right? This is step 2. Most products skip step 2. They only tell you, yeah, this is what it'll look like if you do it. They don't tell you, can you do it? So if he does it, right? Now this is what we're doing. We're doing a what if, right? We're going to forecast out. What if he does sell 1.4 million? If he sells 1.4 million, he makes 5% profit normally. So we're going to expect that he's going to make $70,000, right? That's going to be his net profit after tax is $70,000 based on, you know, his historicals, which is about 5% net profit. Not bad. $70,000 in a year on 800,000 or 1.4 million. It's not bad. But you got to remember, he's also a business owner. He probably has other benefits it takes out of it as well. This is a nice little company that he's got running. So that equals his 5%. When we create the new balance sheet, right, we have the old one in the blue. Then we're going to forecast the new one based on the new sales. And the new sales is 1.4 million. That's what we're growing to. That's what we're going to, is 1.4 million. Now, from there, you've got cash, right? If we have 2% of 1.4 million, that's actually 28,000. And we've got accounts receivable. We've got 25% of accounts receivable is 350,000. And you have inventory. Inventory at 28% of 1.4 million is 392. Can you see how I'm going down the left side? All right, so I'm just going down the left side, knowing how the balance sheet works, and I'm going down the left side and calculating. When I add up 28 plus 350 plus 392, that gives me $770,000 in current assets. So that's what I would expect from him in the following year is, hey, if you're going to grow to 1.4 million, you're not going to have 440 in current assets. You're actually going to have 770. And notice how much, you know, accounts receivable went up, right? Well, that's money he doesn't have. He made it in profit, but he doesn't have it yet. Then, of course, we're going to say he didn't buy anything, right? I mean, we can make this more complicated and add in some purchases of equipment. We're going to say he's just going to use the equipment that he has in place. So he keeps his equipment at 256, and he has his leasehold improvements of 220, which gives him total assets now of 1.2 million, right? 1.2 million. So he had 900,000 at 800,000 in sales. Now at 1.4 million, his total assets is 1.2 million. Now, here's where it gets a little tricky. And here's also the reason why I set this up in a left side, right side instead of top and bottom. Because what we know about the balance sheet and what we know to be true is that if total assets equals 1.2 million, then so does total liabilities and equity. It has to, right? It has to equal 1.2 million. Now, instead of coming down the left side, we're going to go up the right side. So you're going to work it like a U shape. And it's important because we're going to see how much money he's short, right? That's how we're going to end up, is how much money is he short of being able to accomplish his goal. So when we work it up the right side, right, we're going to work it right up the right side from 1.2 up to notes payable. You've got to look at the equity. Where does the equity come from? And like I said before, equity is retained earnings plus net profit, right? That's how retained earnings increases. Now, last year at $800,000, he made $506,000 in, or he had $506,000 in equity. But we said that if he sells 1.4 million, he's actually going to make $70,000 in net profit this year, right? So you're going to have to add those two things together. You're going to take, the 506 and add in the $70,000, and that gives us a new equity, if he does make his sales goal, of $576,000. You see how I did that? I took what was already on the balance sheet for retained earnings, and then said, what if he does make his 1.4 million? We're going to anticipate he's also going to make $70,000 in net profit. Net profit gets put on the balance sheet in the form of retained earnings, increasing equity by $70,000. So the new equity is $576,000. So knowing that's true now, if total liabilities and equity is 1.2 million and equity is 576,000, that means that total liabilities has to be 670,000. So 670 plus 576 equals 1.2 million, right? You see how I'm doing that? Now we're going to work it up the backside. So then we go to total term debt, right? Long-term debt. And in long-term debt, he had 234,000 because we didn't take on any more. So 234,000, when we subtract that from 670, his total liabilities is 670 minus 234. That means his current liabilities has to be $436,000. $436,000. Okay, now we're starting to see where this is going, right? Because when I calculate accruals at 5% is still only 70,000, and accounts payable at 17% is 238,000. Does 238 plus 70 equal 436? No, it doesn't. Matter of fact, we're actually going to be short because it used to be that we didn't have any notes payable. We didn't have any short-term debt, any line of credit, any credit cards. But because accounts payable at 238 and accruals at 70 do not equal 436, we're going to have to take on some debt. Right? This is the connection between can I grow and will I be able to grow? Right? Do I have enough money or can I physically do it? When I look at notes payable last year, again, it was 0. But this year it says, based on math of the balance sheet, that he needs $128,000 to be able to grow that much, right? He's going to have to get a line of credit. He's going to have to use credit cards or increase his cash somehow. It's just physically not possible running the business the way he does today to grow 75% without adding more money to the company, right? Growth takes funds. Growth takes it. So, I mean, it's like a monster, right? A company just eats money while it's growing. In this case, not only do you know, hey, I can grow to 1.4, but if I'm going to grow to 1.4, I need $128,000 more. What is that going to do? Well, if I'm an advisor, I'm going to say, hey, are you comfortable? Are you comfortable with getting a $128,000 line of credit? If you're not, then let's back off our growth, right? Let's be safe. If you are, hey, let's go for it, right? Now, what you got to be careful of is that sustainable? Can he do it without taking on too much debt? And that's something that we'll talk about in a later lesson. But in this one, we're talking about, hey, working the balance sheet backwards, forecasting the balance sheet. We know that he can grow if he actually takes on debt, right? So pretty cool trick. That's a growing money inside your company is knowing how to keep money inside it, or do you need more in order to grow? Now let's talk about keeping cash, right? Keeping cash is like you have it. It's sitting there inside your company, but sometimes it leaks out. Sometimes it goes somewhere and you don't know where it's going. So what we've done is that at Finagraph we have what's called a financial impact worksheet. And it's 6 things that are directly attributed to cash leakage, right? This is places within your company that cash leaks, and sometimes you just don't realize it. But if you're in a short-term or a cash flow problem, look at these 6 first and try to improve your cash position. And here's how you do it. I mean, on this first sheet, I've got gross profit, net profit, and sales. I'll look at those first, right? So gross profit, net profit, and sales. I'm using the numbers right off of the financial statements that are in the resource material. So the sales on there is 7,100. And when I say target, that means the industry average. If I know the industry average, I'm going to use the industry average. If not, I'm going to say target of being what my goals were inside my company, or what I want it to be, right? So it's either the industry average or any goal that you want. That's your target. This is what I'm trying to achieve, right? So in this case, we're saying that the company wants to earn 32.2%, right? Why? Because the average company earns 32.2%. If they did that, they would have made 2.2 million. And I've left off the zeros, but we're talking in millions here, based on the financial statements. So they would have made 2.2, almost 2.3 million. Instead, when you look at their financial statements, they only made 2.2, which is 2.1, almost 2.2. Subtract the difference. The target is what I want. Actual is what I did. When I subtract them, that's $106,000 left on the table. You're thinking, wow, I mean, and believe it or not, that's a 1% increase, right? Because of what they had, if you calculate it, it's somewhere around 31.7, and this is 32.2. So we're talking about, almost a 1% increase. So 1%, I mean, think about that. If 1% gross profit is all you need, one more percent, why not call your vendors and say, hey, listen, I've got a problem down here. I'm going to need about a 15% haircut on all my products I'm buying from you. Well, your vendor's probably going to laugh. Hey, we're not going to be able to do that. Maybe I'll give you 5%. Well, think about it. 1% in this case gives you $100,000. If the vendors give you 5% off, hey, that's $100,000 in your pocket, right? Because if expenses are already covered, that money goes directly to net profit. So this is one way you can see that a 1% increase in gross profit puts $100,000 back into your pocket. Now, looking at net profit, and believe it or not, I've got a negative on this. All right, so it's a negative because I'm worse than my target. So I put a code on these, and I'll show you why I use the code in a second. But I put a code. So I've got a negative sign next to the gross profit because I'm worse than my target. If I'm better than my target, or better, we'll say competitors, if I'm using the industry average, if I'm better than my competitors, I'm going to use a positive sign. So on net profit, again, sales on 7 million. I want to earn 3%. Doesn't take much to make me happy. 3%, I'll be happy. And if I did that, I'd have $220,000 in profit. But in this case, our sample company actually earned 11,000. Big, huge difference, right? The average competitor, because I'm using the industry average as my target, is 3%. We only made 11,000. That's actually $209,000 difference, right? Think about that. We're way worse than what our target is, what the industry average is. So we're worse. But you got to look at it 2 ways here. One, yeah, my net profit is worse, but I'm also not good enough in gross profit. So $100,000, 106, is actually part of that 209 if you look at it, right? So if I added 106,000 to my average company, if I added 106,000 to my gross profit, it actually flows through to net profit. That means I have $100,000 too much operating expenses. If you want to know how much to cut, do this exercise, because it will show you the difference between the 209 in net profit and the 106 in gross profit is exactly how much you should cut in operating expenses. It's exactly how much. It tells you exactly what to do. Okay, on sales, this is saying, hey, I bought equipment, I've got assets. How much should I be generating with my assets? This is what we're talking about. So I've got about $3.6 million in assets. A typical company generates $2.3 per dollar invested. Let me show you how to read that target sales to assets, or sales to asset ratio. Is for every dollar I've invested in equipment, that piece of equipment is supposed to generate $2.30, right? So that's the target. I want this to generate $2.30. It's another good way to forecast your sales if you buy a piece of equipment. How much am I already generating per equipment? And that's how much my new piece should be able to generate as well. So if I generated $2.30 for every dollar invested in assets, I'd have $8.2 million in sales. But I didn't sell $8.2 million. I only sold $7 million. So with that, I should have sold 8.2 or could or can sell 8.2. I only sold 7.1. That means I can actually sell another $1 million with the equipment that I have in place. That's kind of a good thing to know. Even though it's worse, it's negative, even though it's worse than my target, it shows me that I have more capacity in my current operation. I don't have to go buy new equipment to increase revenue. I have the equipment sitting right here inside my building. So that's the first three. The next three are inventory, accounts receivable, and accounts payable. These should look familiar because this is your working capital cycle. This is your cash conversion cycle. How long does it take cash to move through your company? So when we look at inventory, if you ever want to know how much you should have, right? People go, I don't know how much inventory I have. I just buy it and keep it on the shelf. Well, this is the way to find that out. How much did you spend in cost of goods sold? And then you're going to divide that by the inventory turnover rate of your competitors, right? The average. If you can find out the industry average for your type of business, this is saying that they have to replace inventory 5.5 times a year, right? They're buying it and selling it 5 times a year. So when I take my cost of goods sold, which is how much I actually sold, and divide that by how many times I should have had to replace it, that gives me $895,000 that I should have on the shelf, right? That's what it's telling you. What I sold divided by how many times I should have bought it in a year equals how much inventory I should have on the shelf. That's your number, right? How much inventory you should have? $895,000. Well, in our case, though, we actually have $1.2 million. So how much inventory is too much inventory? Well, if I'm consulting with this company here, I'm saying we got $322,000 worth of inventory that's too much. And believe it or not, if you reduce it, if you reduce the inventory from $1.2 million down to $895,000, we're going to put $300,000 of cash back in your pocket. They're going, what? How do we do that? By not replacing it, right? What you normally do is when you sell something, you actually go to the vendor and replace it. You buy another one, you give him more money. Let's not do that. Through attrition, let's work our inventory level down to what it should be and keep that money in the company. You're going to improve your cash position just by maintaining the right level of inventory. Then we've got accounts receivable. All right, so we already know we have too much inventory. We got to reduce that by $322,000. But the next two we're actually good at. When I calculated those up on $7 million in sales, they actually collect 8 times per year. That's the turnover rate is what we want, right? The target turnover rate is most companies collect 8 times per year from their clients. So they should be owed right now $855,000. That's what they should be owed. But they're not owed that. They're only owed $654,000. That means they do a better job collecting, right? When it comes down to it, this sample company does a better job collecting. They actually like to make the phone calls to the vendors, right? And they like to make them get the money coming in because they're owed less. And that gives them a financial impact of $200,000. So if you compare this company to the average company, they have $200,000 more in cash because of it, right? Because of their collection practices. And that's a positive thing. We're better than our competitors or better than our target. And then the last one, accounts payable, is we're owing right now on our inventory $4.9 million. And we've the average company actually pays their vendors almost 11 times per year. So that means they should owe their vendors currently on the balance sheet $456,000. But they don't, right? This company actually owes $750,000. And you're not going to believe me when I tell you this, but it's true. That's good, right? You're like, well, wait, how's that good? Everyone else owes $400,000. This company owes $700,000. It's good because they haven't paid it. The cash is still in the company. And when we talk about cash and cash flow, cash that is still in your pocket is better than cash you gave to somebody else, right? That's basically what we're saying. So from a bank's perspective, they're going to call this a source of cash, right? Now, all the phone calls they like to make to their customers, boy, they don't answer them from the vendors, right? That means they're not paying as fast as their vendors are. And the financial impact of that, though, by stretching their payables, this is the visual look. It's stretching a person's payables, is $294,000. So they actually have $294,000 more in their pocket than their competitors do, so that's positive. So what do I do with that? I just told you 6 things. I've got 4 negatives and 2 positives. What do I do? If you want to talk to your business owner, your client, or yourself, if you are the business owner, create this map, right? It's called a cash impact map, and it shows you where you're leaking cash. If you notice, I got gross profit, net profit, sales, inventory, AR, and AP down the side. Up at the top, I'm going to put the negative sign on the left side and the positive sign on the right side. Then I'm going to create a bar graph, right? When I create the bar graph, it gives me the visual evidence I need to make the next decision. In gross profit, we were negative of $106,000. In net profit, we were negative $209,000. Remember that? All right. So by improving my gross profit, I can get $100,000 more in cash. By improving my net profit, I can get $200,000 more in cash. You have to kind of do those together. Net profit you can't touch. You have to touch sales, gross profit, or operating expense. Net profit is just a result. So in this case, we're going to improve our gross profit by 1%, gives us $100,000. The other $100,000 we're going to get from cutting operating expense, right? We're going to cut operating expense. It's the difference between the two. So we're going to improve gross profit by 1% and cut operating expense by $103,000. That's basically what that's telling us. Then we can improve sales by $1.2 million. That one's the hardest. I always just kind of leave that alone. Yeah, let's find the other cash first, and then we'll go back and get sales. But, especially if you find out you have a gross profit problem, you don't want to add more sales to it because it might compound the problem, right? Then on inventory, we found out that we had $300,000 too much in inventory. Those are the things we were bad at compared to where we want to be, which is just average to the industry. The other 2 things we were good in accounts receivable and good in accounts payable. If you notice, I went red and green, right? Red's for bad, green's for good. When I'm consulting, talking with my clients, I build this map for them. I say, listen, if you don't know where to start, finding cash, solving a cash flow problem, if you don't know where to start, look for the longest red line and start there, right? And now you say, Mike, you just told me not to worry about sales until I figure the other ones. All right, so where are we going to start? We're going to start on inventory. We're going to reduce our inventory level down, and we're going to fix gross profit, which ultimately helps us fix net profit when we cut expenses. So the 3 moves that I'm going to tell him is cut inventory, all right? Reduce inventory, just don't replace it. Then we're going to call our vendors, get that 1% better in gross profit. We're going to cut $100,000 in operating expense. And then we can focus on sales, right? Because we got everything else working properly. Don't touch receivables and payables unless they become a problem with your vendors' relationships. But other than that, look for the longest red lines and focus there. This is your priority of work. It sets your agenda. If you're a consultant and you're not doing this, you're not helping them find cash in their business. Look here, go and tell them to focus on these areas and put more cash in their business. The other thing I want to tell you about is when we talk about expenses is disciplined expense control, right? You got to ask yourself, hey, do we need it? Can we afford it? Right, that's basically what we're talking about. Do you need it? Can you afford it? Just draw this basic, chart. No. But if you need it and you can afford it, that's when you buy it, right? If you don't want to do that, I get it. Follow this rule. Here's the hard and fast rule for expense control. Adjust your operating expense, by the same amount that your gross profit increases or decreases. That's going to maintain profitability. All right. So if you have $400,000 less to spend, then spend $400,000 less. Just look at the change. How much gross profit moved up or down? I can do the same with operating expense. They should move together, right? Just like that, and you'll maintain your profitability. So I want to thank you. We talked about growing, getting, and keeping cash. It's really a pretty cool thing to be able to sit here and go through this, talk about how to get money into the company to begin with. We talked about growing money within, growing money or being able to grow your business and keeping money in and determining whether or not you can grow with debt or without debt, right? That's basically what we're doing is forecasting a balance sheet. Not many people talk about that, but it's super important, right? Just super important. And then lastly, we talked about the financial impact and finding hidden cash inside your actual business. So how do I find that hidden cash? How do I, what are the actions that I take? What's my priority of work? What's the agenda that I do? Look at the 6 items where cash is most likely to leak and determine whether or not yours is leaking. And compare yourself to industry average or any other number that you want to. Maybe it's just a goal. All right, so those are the 3 things. So if you enjoyed this, I'm going to invite you again to become one of our community members. If you go to elevatefinancialtraining.com/members, just an email address. When you give the email address, all you do is get access to the file sharing. You get special webinar invites. You get discounts on products and prices that are only special to you. And it doesn't cost you anything, right? Really what we're doing is we're building a community where we can share, where we can, we can educate and really elevate small business, right? So give your business the boost that it needs and become a member today. So I appreciate it. My name is Mike Milan, also called Cash Flow Mike. And look for me in the future. We'll be doing this again.